Thank you for joining us for Student Loan Repayment Strategies. Find solutions that work for your budget. The definition of a student loan: it's a loan that is used to pay off education-related expenses, such as tuition, room and board, textbooks. Many loans have a low interest rate like Perkins loans or Stafford loans. In general, students are not required to pay back these loans until the end of a grace period, which usually begins after they have completed their education. There are different types of student loans, and I'm going to go over them now. The first one is a subsidized federal Stafford loan. Now, the subsidized federal Stafford loan is a federal student loan available to students with demonstrated financial need. Subsidized loans are among the least expensive loan options for students because the federal government pays the interest while the student is attending college on at least a half-time basis and during other periods of authorized deferment. The unsubsidized federal Stafford loan is a federal student loan that is not based on financial need. Interest accrues on unsubsidized loans from the time the loan is disbursed by the school. The interest is not paid by the federal government. We also have direct subsidized loans. Direct subsidized loans are available to undergraduate students with financial need. Your school determines the amount you can borrow, and the amount may not exceed your financial need. The U.S. Department of Education pays the interest on a direct subsidized loan while you're in school at least half-time for the first 6 months after you leave school, which is referred to as a grace period, and during a period of deferment. That's a postponement of loan payments. Direct unsubsidized loans are available to undergraduate and graduate students. There is no requirement to demonstrate financial need. Your school determines the amount you can borrow based on your cost of attendance and other financial aid you receive. You are responsible for paying the interest on a direct unsubsidized loan during all periods. If you choose not to pay the interest while you are in school and during the grace periods, your interest will accrue and be added to the principal amount of your loan. The next type of loan is a direct consolidation loan, and this allows you to consolidate or combine multiple federal education loans all into one loan. The result is a single monthly payment instead of multiple payments. There's also the federal Perkins loan or Perkins loan, and this is a need-based student loan offered by the U.S. Department of Education to assist American college students in funding their post-secondary education. The program is named after Carl D. Perkins, a former member of the U.S. House of Representatives from Kentucky. There's also what is known as PLUS loans, and these are federal loans that graduate or professional students and parents of dependent undergraduate students can use to help pay for college or career school. PLUS loans can help pay for education expenses not covered by other financial aid. Under the Federal Family Education Program, private lenders made federal student loans to students, and guarantee agencies insured these funds, which were, in turn, reinsured by the federal government. Now I'm going to quickly discuss the two words that you hear the most when you finish school or when you're discussing student loans. The first is forbearance. Forbearance is a period during which your monthly loan payments are temporarily suspended or reduced. Payments on your loan principal are postponed, but interest will accrue during the forbearance period. Forbearance is intended to help you out in times of temporary need. Note that the use of forbearance may cause the loss of borrower benefits, such as repayment incentives that can lower your interest rate for certain loans. Cosigner release for private loans includes a one-time payment requirement, and forbearance may delay eligibility. The next is deferment. Deferment is a period where you postpone making payments on your loan. Interest doesn't accrue on subsidized federal loans. You are eligible if you are engaged in a graduate fellowship program, rehabilitation training, internship, or residency, or teaching in a teacher shortage area. You are also eligible if you are enrolled in an eligible school at least half-time, or you are a parent with a Parent Plus loan who needs to defer repayment while your student is enrolled in school at least half-time. If you're having temporary issues making your student loan payments due to unemployment or economic difficulties, be sure to let them know as soon as possible to avoid becoming delinquent. If you are unemployed or working less than 30 hours per week and seeking full-time employment, you may be eligible for an unemployment deferment for up to 3 years. If you're working 30+ hours a week but you aren't able to afford your monthly payment, you may consider a graduated or income-driven repayment plan, and I'll discuss those a little bit more later. Lastly, they have economic hardship deferment, and you may be eligible for an economic hardship deferment for up to 3 years depending on your situation. Now that we know what types of loans are available, and we discussed a bit about forbearance and deferment, let's get into the topic of this webinar. Before you get into payment strategies and plans, you have to know who you owe. And you're going to want to check out the NSLDS, the National Student Loan Data System. Basically, this is the U.S. Department of Education's central database for student aid. It receives data from schools, agencies that guarantee loans, the Direct Loan Program, and other U.S. Department of Education programs. The site displays information on loans and/or grant amounts, outstanding balances, loan statuses, and disbursements. Now, in order to use the NSLSDS site, you need to provide your FSA ID, username, and password. If you do not have an FSA ID, you can create one on the site. Now we're going to discuss basic student loan repayment plans. The first is standard repayment. Now this is offered at a 10-year term. Payments are a fixed amount, and you'll save the most money on this plan because you'll pay less interest. The next is graduated repayment. This is also a 10-year term. Payments will start low and then gradually increase every 2 years. You'll end up paying more for your loan over time than under the 10-year standard plan. And then lastly, there's extended repayment. This is a 25-year term. Payments may be fixed or graduated, and your monthly payments would be lower than the standard 10-year plan, but you will also end up paying more. And I want you to know that these sets of repayment plans are for federal loans and not for private loans, which we will discuss a little bit later on. Now we're going to get into income-based programs. There are 4 types of income-based plans: the IBR, which is income-based repayment, the ICR, which is income-contingent repayment, the PAYE is pay as you earn, or the RePAYE, which is the revised pay as you earn. Now, eligibility for income-based repayment depends on which loans you have taken out for your education and when they were taken out. The following federal student loans from the Direct Loan and Federal Family Education Loan programs are the ones that qualify for application: Direct Plus loans, Direct Consolidation loans without plus loans that were made directly to parents and not as co-signers, Direct Subsidized loans, and Direct Unsubsidized loans, FFEL Plus loans, which is the Federal Family Education Loan, FFEL Consolidation loans without plus loans. If you do not have one of these types of loans, you may still be eligible for the IBR by consolidating your federal student loans into the Direct Loan Program. And second, there is the interest payment benefit. If your new monthly payment isn't large enough to pay the accruing interest on subsidized portion of your direct loan, the federal government will pay it for you for a period of up to, but no more than 3 consecutive years once you begin your IBR repayment program. This is one of the many forgiveness aspects that federal student loans offer. Now, when it comes to income-based repayment, monthly payments are determined by AGI, Adjusted Gross Income, household size, and state of residency. If filed taxes jointly with spouse, combined income is used for calculation. If filed taxes separately or single, only that income is used to determine your monthly payment. The government will reevaluate income every 12 months to determine payments each year. Any remaining balance is forgiven after 25 years. If, over the lifetime of this loan, you make 300 qualified payments and the loan is still not completely paid off, any remaining loan amount will be forgiven and legally discharged. However, this discharged amount is considered taxable and must be paid for the year it was forgiven. For example, a loan discharged in 2013 must be paid with other 2013 income taxes due in 2014. Now, the payments are based on income, so that means they will be affordable for you, and reevaluation can be done at any time based on a decrease in income. Any increase in income will not affect payments until the end of the original 12 months. So how does IBR payments make them more affordable? Well, IBR uses a kind of sliding scale to determine how much you can afford to pay on your federal loans. If you earn below 150% of the poverty level for your family size, you are required to pay a loan payment of $0. If you earn more, your loan payment will be capped at 15% of whatever you earn above that amount. Unlike with IBR and PAYE, which I will talk about next, your income doesn't affect your qualification for Income-Contingent Repayment, which is ICR. Only borrowers with federal direct loans can sign up, but if you have other types of federal loans, you can become eligible by combining them into a federal direct consolidation loan. Your income and tax filing status and the number of people in your household determine your monthly payment under Income-Contingent Repayment. It's capped at 20% of your discretionary income or the amount of your fixed monthly payments on a 12-year loan term, whichever is lower. ICR also extends your loan term from the standard 10 years to 25 years. At that point, the federal government will forgive any remaining balance. This lowers your monthly payment, but it also increases the amount of interest you'll pay over the life of the loan. Plus, the forgiven amount will be taxed as income. That's why switching to an ICR plan or any other income-driven plan is a trade-off. If you need extra monthly cash now to cover basic living expenses, consider switching to an income-driven plan. But if you can afford to stay on the standard repayment plan, you'll save money on interest. Now, you have to remember that you have to resubmit information about your income and family size each year, even if your situation hasn't changed. If you miss your annual deadline, your payment will change to what you would pay in the standard 10-year plan until you resubmit the information. You will generally have a lower monthly payment on IBR, PAYE, or RePAYE, but there are cases in which ICR might be your best option. In one of those cases, that would be if you have a Parent Plus loan. ICR is the only income-driven plan that borrowers with Parent Plus loans can use. Parent Plus loan borrowers have to consolidate to a federal direct consolidation loan to qualify, but once they jump through that initial hoop, being on an ICR plan can free up cash in their monthly budgets. And two, if you can't afford a standard repayment plan but can afford more, you'd pay on another income-driven plan. Income-contingent repayment plans can be a good middle ground between the standard plan and IBR, PAYE, and RePAYE. Those three plans cap borrowers' monthly payments at 10% or 15% of their incomes, less than the ICR's 20% cap. If you don't qualify for those plans or can afford to pay more, making payments on ICR could end up saving you in interest in the long run. Now we're going to discuss the PAYE, or Pay As You Earn plan. This is a repayment option for federal student loans that has been available since 2012. It can help current students and recent graduates keep their loan payments affordable with payment caps based on their income and family size. PAYE will also forgive any remaining debt after 20 years of qualifying payments. In some situations, your reduced payment under PAYE may not cover the interest on your loans. If so, the government will pay that interest on your subsidized Stafford loans for your first 3 years in PAYE. After 3 years, and for other loan types, the interest will be added to the total amount that you owe. While your debt may grow if your affordable payments are low enough, anything you still owe after 20 years of qualifying payments will be forgiven. So before I get into RePAYE, you have to do the research and pick a plan that is best suited to you. I'm sure it seems like a lot and even a bit confusing, but with the proper research and guidance, you can get into the right plan. Now I'm going to discuss the RePAYE, or Revised Pay As You Earn. Other income-driven plans base your eligibility or how much you pay on the year you took out the loan. RePAYE removes those obstacles. There is no time requirement to participate, and everyone receives the same benefit. Here's how it's different from the other plans. All PAYE participants pay a maximum of 10% of their incomes and receive forgiveness after 20 years of payments. But you can't sign up if you've had any outstanding loan debt before October 1st, 2007. RePAYE is a good option for anyone who couldn't sign up for PAYE and would have only qualified for the less generous 15% cap on payments on IBR. RePAYE gives those borrowers the opportunity to limit their loan bills to 10% of their incomes. RePAYE also treats forgiveness differently for undergraduate and graduate student borrowers. The other plans offer the same forgiveness timeline regardless of the course of study you borrowed loans for. All borrowers on PAYE get forgiveness after 20 years. For instance, whether the loans are from undergrad, grad school, or a mix. Under RePAYE, if you took out any loans for grad school, all your loans will be forgiven after 25 years. If you only have undergrad loans, those will be forgiven after 20 years. Lastly, there's Public Service Loan Forgiveness, or PSLF. This is a program for federal student loan borrowers who work in certain kinds of jobs. It will forgive remaining debt after 10 years of eligible employment and qualifying loan payments. So who can get PSLF? This program is for people with federal student loans who work in a wide range of public service jobs, including jobs in government and nonprofit 501c3 organizations. So what are eligible jobs? In most cases, eligibility is based on whether you work for an eligible employer, and your job is eligible if you are employed by a nonprofit, tax-exempt 501c3 organization, are employed by the federal government, a state government or local government, or even a tribal government. This includes the military and public schools and colleges. Or if you serve in a full-time AmeriCorps or Peace Corps position. What is not eligible are labor unions, political organizations, nonprofits that are not 501c3 and do not offer qualifying services and religious instruction. It covers federal, Stafford, Grad Plus, or Consolidation loans as long as they are in the direct loan program. Borrowers with FFEL loans must switch to the direct loan program to get this benefit. Only payments made after October 1st, 2007 count towards the 10 years, 120 monthly payments, not necessarily consecutive, required for public service loan forgiveness. Qualifying payments are payments made through the William D. Ford Direct Loan Program in any of the following 3 repayment plans: the ICR plan, the Standard 10-Year Repayment Plan, and the IBR plan. To count, these payments must be made while you are working full-time in an eligible job. Full-time, according to the final regulations issued by the Department of Education, means an annual average of 30 hours per week, or the standard for full-time used by the employer, whichever is greater. For people working part-time at 2 or more qualifying jobs, full-time means an annual average of 30 hours across all jobs held. In professions such as teaching, annual contracts that include at least 8 months of full-time work will be treated as the equivalent of a full year's employment. If you meet all the criteria, the earliest your remaining debt could be forgiven is October 2017. After your 120th qualifying monthly payment, you will need to submit the PSLF application to receive forgiveness. The application is under development and will be available prior to October 2017, the date when the first borrowers will be eligible for PSLF. You must be working for a qualified public organization at the time you submit the application for forgiveness, and at the time the remaining balance on your loan is forgiven. To get the PSLS forgiveness checklist, you need to visit the NSLDS website, which is www.nslds.ed.gov, to verify that you have a direct federal loan. You need to verify that your employment qualifies at the Department of Education website. Keep track of your employment by holding on to check stubs and tax returns. Fill out the employment certification form also found on the Department of Education website, and continue to work over 30 hours a week, make a total of 120 monthly payments, and then wait. Now I'm going to discuss private loans. Private student loans cannot be combined with the federal student loan consolidation. They should be consolidated separately, as the federal consolidation loans offer superior benefits and lower interest rates. The benefits of private loan consolidation are obtaining a single monthly payment and resetting the term of a loan to possibly reducing the monthly payments. Interest rates on private student loans are based on credit scores. Lower interest rate is possible if the client has significantly improved their credit score since obtaining the original loan, and there may be additional fees charged for originating these loans. So what is loan consolidation? This is simplifying repayment by centralizing all loans into one bill. You possibly lower your monthly payments by increasing the repayment period up to 25 years. You can access alternative repayment options not available to the previous loan, and perhaps switch variable interest rates to fixed interest rates. Some important features when it comes to loan consolidation is a fixed interest rate for the remaining life of the loan. The interest rate is the weighted average of the interest rates on the loans being consolidated, rounded up to the nearest 1/8%, and that's fixed for life. Federal loan consolidation is entirely free, and you could avoid the many predatory debt consolidation or debt relief scams. Some consequences of loan consolidation are increased repayment periods, mean an increase in monthly payments and total interest paid. Potential loss of benefits that were connected to the original loan, including interest rate discounts, cancellation options, refi, etc. And then once consolidated, consolidation cannot be undone. Also, borrowers do not need multiple loans to consolidate. Consolidation can be used to move a single FFEL loan to a direct loan. This can be used to qualify for PSLF or simply to choose a new servicer. Putting a single direct loan into a consolidated direct loan, perhaps to allow a parent plus loan to use income-contingent repayment. And consolidation can be used to get a loan out of default if used properly. Since I said default, we're going to discuss delinquency and default now. So when are your student loans considered delinquent? Delinquency occurs when you don't make your monthly federal or private loan payments on time. Your loan is considered delinquent when payment has not been made on the day it is due. Being delinquent on your federal or private loans may be a serious situation that might lead to a long-lasting or permanent consequence to you as the borrower or cosigner. Consequences of delinquency may include your information being reported to the consumer reporting agencies, and that may impact your credit score. Increase in your loan balance may occur with the addition of late fees and other charges. Potential loss of your loan benefits or repayment incentives. Loss of your entitlement to deferment or forbearance options on federal loans. And loss of your entitlement to forbearance options on private loans. And once in default, federal loan guarantee agencies may garnish your wages or offset your state and federal tax refunds and other payments made by the federal government to you. This means they can take your federal and state tax refunds or a portion of your disposable income. Please remember to be careful. All of the information that I have given you about repayments and consolidations is very important. If you want to enter into a plan or to consolidate your loans, before you call a company that says they can do it for you, contact the Department of Education and go on the NSLDS site or contact your servicer directly. These are things that you can do for yourself, but if you feel that you need help, then make sure and do your research on the companies before you make a choice. Please check out our free online educational tools, from budgeting tools, debt calculators, quizzes, downloadable PDF self-help booklets, newsletters, etc. Thank you again. For more great information, be sure to sign up for our newsletter and our social media channels.